What's going on, everybody? Welcome back to another section here at the Day Trading Institution. So again, taking it step by step, I really want you guys to kind of have a good understanding of the basics. So in this section, all we're simply going to be doing now is pretty much going over the anatomy of trading. Now, in this lesson, what we're going to cover is our role as traders and kind of, what it is to be a day trader or a swing trader or a scalper, whatever type of trading form you decide to go with, a breakdown of an actual trade. Now, not necessarily, me going on the charts and actually breaking down a trade, but a breakdown of the process of a trade and how you can actually make money in this market, the simple math behind a trade, what causes price to move, and the different types of trading. So now let's kind of get into what our role as traders are. So our role as a trader is simply we are going to be looking to buy or sell a currency pair to capitalize on the daily movement, on the daily volatility. Every single day we have trading sessions. Within those trading sessions, there's going to be more movement in the market. That's going to cause a fluctuation in the exchange rate, and we're simply looking to capitalize off of that fluctuation on the exchange rate. That's as simple as it is, right? Now let's go over the breakdown of a trade. So let's say you're going to be trading the currency pair GBP USD, which again, let's go back to the basics. GBP is going to be our base currency. So the USD is going to be our quote currency, right? And now GBP USD is, let's say, is trading at 1.21, which is the current exchange rate, right? 1.21, let's just say, is the current price between the bid and the ask of the exchange rate that the brokers are going to be selling to us. Now, let's actually break down a trade. So you really have only two options here. So option one to trade GBP USD at 1.21 is you can either buy the base currency if you believe the base currency will appreciate in price relative to the quote currency. So if you see GBP USD actually going from 1.21 to 1.25, let's just say, then typically you're going to be looking to go long or buy, right? Now, your second option is to either go short or sell, which theoretically in this situation, you would be looking to sell the base currency GBP if you think the base currency will depreciate or lose value relative to the quote currency. So if you think that GBP is going to be going down and the USD is going to be going up, then we're going to be selling the at 1.21, which is the current exchange rate, because again, our base currency is going to be really what we're looking at in terms of price here. So if you see GBP USD, or if you see the GBP going down and you see the dollar looking to potentially rise against the GBP, then we're going to be looking to go short. Now, let's just take it one step further, right? So now, how do we exactly use this exchange rate? So on the actual chart, you're going to see obviously the candlestick chart, and then you're going to see price on the side. We're going to be looking to mark off our levels. Let's say we're looking to take a buy, and we're looking to take price to 125. If you think price is going to go to 120 or 1.25, then you're simply going to be going long. If you think price is going to go to 1.15, then you're simply going to be going short. So all the exchange rate tells us is how much money you have to pay in units in terms of the quote currency, because everything works off of units. And then, to simplify things, it's going to be into lot size. So in order to buy 1 unit of the base currency, right, you have to pay 1.21 US dollars to buy 1 British pound if you're going to be going long. And again, this is the base currency. So again, to buy 1 British pound, we have to pay 1.21 US dollars. And that's done through units and lot sizes. So now what if you're actually looking to go short? Again, it's the same thing. In simple terms, you will receive 1.21 US dollars when you sell 1 British pound. It's as simple as that. So now let's look at the actual math behind the trade. So we're going to have your action here being the trader, and then we have our base and our quote currency. Remember, the base is GBP and the quote is USD. So we're pretty much going to be trading GBP here. So let's say you're going to be looking for the exchange rate to actually go up, meaning you're going to be looking for the Great Britain pound to rise against the US dollar. And let's just say the current exchange rate is going to be 1.21. Now let's say you buy 10,000 pounds of GBP USD at the exchange rate of 1.21. So you buy 10,000 pounds and you're going to multiply that by the current exchange rate at 1.21, and that trade is going to cost you 12,100 US dollars. Now, let's say 2 weeks go by, because remember, we're looking to buy because you thought the exchange rate or your trading hypothesis told you that the exchange rate is going to increase in price. Now, let's say 2 weeks go by and you exchange your 10,000 pounds back into US dollars at the exchange rate of 1.27. Remember, the exchange rate is the current trading price. Now, again, you still have 10,000 pounds. Even though you bought for $12,000, you bought 10,000 pounds. Now, since the exchange rate has actually gone up and increased in value, we're now going to multiply our 10,000 pounds by 1.27, leaving us at $12,700. And we've made roughly around a $600 profit in total. And that's the basic math behind a trade. So what actually makes price fluctuate? Now, what actually makes price fluctuate, and the only reason price moves, is all simply based off of supply and demand. It's as simple as, let's just say a pair of Jordans are on sale for, let's just say there was a total of 100 new pair of Jordans for sale, and each Jordan was going to be selling at $100. Let's just say you bought a bulk discounted price, because typically in a trade you're going to wait for price to pull back. In pullbacks, or what we call discounts, right? Let's just say you bought 80% of the value of, or 80% of the actual Jordans that are available in the market, and you're now new Jordans that were typically going to be $100 per shoe. Let's say you bought it at $90, whatever the case might be, is right. Now, all you simply did is you bought 80% of the supply of those Jordans, and now there's going to be a higher demand for those Jordans because you as a sole individual had bought the majority of the shoes that are on the market. So now there's less shoes available in the market, and the demand for the shoe actually increases. So now let's just say, since the demand of the shoe actually went up in value, right, those Jordans cost $150. Now, if you were to sell, again, every single Jordan you bought, 80% of them for $150 because they were retailing at $100, right? You're going to make a $50 profit on each of the shoes that you ended up purchasing, or technically a $60 profit if you got the shoes at a 10% discount. So you're making $60 on top of every single shoe that you purchase, and that's how basic supply and demand works. So the more demand that there is for something, in this case the shoe, because you bought most of the shoes that were available in the market, again 80%, the demand is going to significantly increase, right? Now, when there's more supply of the shoes, meaning that you're going to put 80% of those shoes back on the market, the supply is going to decrease after you've already sold all of the shoes that you've previously owned. So less demand equals a price decrease, and then less supply equals an increase of price. And this is simple basic supply and demand, and this is the only reason the market moves, is because of supply and demand, right? Now, you could take into account fundamentals and everything else, but that's just basic supply and demand, right? Let's just go over that. That's the main reason why the market moves. Now, there's two different types of tradings. You have to identify what type of trading suits your personality. Are you somebody that's more patient? You can hold your trades for a little bit longer. You can wait for things to play out a little bit longer. You know, maybe are you a little bit of a slow reader? And this is not to make fun of anybody, but not everybody's going to have the capabilities to make decisions on the fly like a scalper is. And this is something you're only going to be experiencing with time. I'm here to just expose to you the different types of trading that there is. So day trading is pretty simple. When it comes down to day trading, and me personally, I could do day trading and swing trading because I'm a little bit more of a patient person. And to be honest, you know, you're going to catch way bigger moves day trading and swing trading. So when you're buying or selling within the same day is day trading. When you're typically buying within the same daily candlestick, when you're typically buying and selling within the same trading day. So from 5 p.m. to 5 p.m., that 24-hour time span is typically a day trader, right? Your position is going to be closed out within the same day that they're taken. No positions are going to be held overnight. Like I said, I can do both. Typically, most day traders can also swing trade as well. Now, swing trading, when it comes down to swing trading, trades are held for more than a day, meaning that your position will take a few days to actually play out, and your position is closed within a few days, maybe even a few weeks. Now, once we start holding trades for a few weeks on end, we're typically talking about position traders, which are pretty much a borderline investor at that point in time. And then the last form of day trading is going to be scalping. So pretty much it's the quickest strategy used by active traders trading. When you're actually scalping, you're looking to get out of the market, you're looking to get out of the market pretty much in and out within the same hour even, right? So when you take advantage of small moves that occur with a frequently larger position size, meaning that day traders may use smaller position sizing, but again, the moves that day trader catches are a lot bigger because of the fact that we're holding these positions, we're looking for those big swings.